So traders, sorry about that. We were fiddling around with some mics, which is something you do from time to time. But hey, it's a new decade. New decade. Same four people standing around, scrammed behind this desk here like a weird Mount Rushmore. Anyway, I hope you guys all had a great time over the holidays, right?
Absolutely. How was your holidays? Good?
Yeah, it was
They're
great.
always good.
Absolutely. Time away is always nice.
The kids came home and wrecked the house and ate everything we had. And
I remember doing that when I was like in college. It's the best thing you can do.
absolutely.
Good food. Mom can do the laundry.
Great food.
Absolutely.
Well, anyway, we'll pepper in some holiday stuff along the way. But today our topic is going to be 5 steps to creating a great trading plan in 2020, which is actually, we're borrowing that from a blog we did last January that it was hugely popular, so we thought we'd revisit with some more in-depth analysis. But first, Mick, I think you have a trader shout-out?
Yeah, big shout out to Anthony Hicks. He played the crude oil very, very well last night. Made a little over $5,000.
Anthony Hicks.
Anthony Hicks.
A little long, a little short, but caught a good part of that downtrend after the pop on the news last night. So he's been working really hard at the trading. He's come a very, very long way. And talk about a guy who's truly passionate about what he does. I know he's got a bright future in this industry. So great job, Anthony.
That's awesome.
Yeah, well,
That's huge.
hi, Murat and Norman, and Mick, you kind of posted. I was going to try and guess what he did, but thanks for framing that out for us. So anyway, we have the 5 ways to create a great trading plan. Number 1 is pretty straightforward. It's define the basics. And just to put you guys in the right frame there, by basics we mean planning your schedule and choosing the right product, and also setting some long-term goals.
Absolutely. I think it's really important that when you sit down to trade, if you're looking at other markets, you have a plan of which markets you're going to be trading and when you're going to be trading them. I think it's so often, I think last night's a prime example. A lot of people got in on the short side of things or the long side if you're, whatever side, whichever market you're trading. We saw big moves all over the place. If you see that stuff and it's not part of your plan to be trading, then you should probably stay away because as you saw, the markets quickly reversed, returned back to neutral. So if you don't have that idea of when you're going to be trading and which markets you're going to be trading, you can get hurt really, really quickly.
Yeah, absolutely. And Hogue, I know you were in the S&P pits for a long time.
Yes.
Does that reflect your personality, the equities? Do they speak to you?
Oh yeah, absolutely. I mean, it's it's a product I've been familiar with for a very long time. I was watching it last night with the volatility, and even with 25 or 30 years of experience, I chose not to trade it. It's not my time frame. I'm trading regular trading hours only. I know that that's when I perform the best, and that's when I'm going to be trading.
I think last night was a great example of news movements. We had equities goose up, crude broke, and then at the end of the day, now crude's much lower on the day and equities higher. So I think those news events, it might be a good time to sit on your hands. I know a lot of people who implement one strategy, they don't get seduced by those type of moves on the news. It's not a good way to make or to give back hard-earned money.
Absolutely.
No, yeah, you can get absolutely destroyed that way, and you're kind of like everyone's kind of flailing. But there are some big results as well.
I was watching some of my friends that are long time frame traders on Twitter, and they were talking about, hey, if this isn't what you're into, if this isn't the strategy that you're going to be using on a regular basis, you're probably better off just watching it, letting things settle down, and looking for opportunities in your time frame.
Yeah,
Absolutely.
which ties in perfectly to our second point, which just happens to be establish a time frame for your trades. So we touched on this a little bit. It's a little different with the news events. That's very in the moment and stuff like that. But you should know how long you're going to hold things, what the time frame is, when you're doing it.
Definitely. In addition to how long you might be holding something, it's good to be conscious of what time frame you're making trades off of too. You guys have probably heard me say a number of times, I like the top-down approach. What's the trend on the bigger? Look at the bigger picture. What's the trend potentially on the monthlies, the weeklies, the dailies? Take the higher time frame and break it down from there, and you can move your way to lower time frame charts for better trade locations on your entries and exits. But you don't want to miss the forest staring at the trees. So always have a good idea of what the market's doing. You want to, most money when trading is made following the trend, not taking counter trend trades. So if the market's going up, look for buying opportunities. Doesn't mean you can't make money on the short side in an uptrending market, but the odds are on your side when you are following the tide.
Yeah, those contrary moves you certainly don't want to fall in love with. They are short time frame trades.
Yes.
Absolutely. Like Mick says, take that top-down approach. Get the big picture, get an idea of where that long time frame money is moving this market. Therefore, when you're looking a little bit closer, those 30-minute, hourly, 15-minute charts, you have that in the back of your mind. Okay, the direction of this market is this way. I'm seeing in the short time frame it's making a little bit different a move. Where's my opportunity here, knowing where this is going in the long term?
One more thing I want to add about time frames is, with newer traders, usually they're starting on a shorter time frame. They're looking at 5-minute charts. If you're looking at a small time frame and you're kind of playing trades close to the vest, meaning you're looking for small profits in the form of ticks and only really wanting to risk small losses too, the short time frame, there's a lot of noise. The back and forth gyrations if you're looking at a candlestick chart, I'm talking about price bar overlap, and a lot of traders get tagged. Their stops get tagged on those, only for the market to turn around and move in their direction. So just something to be very conscious of. The higher time frame is in charge. Try and follow that.
Yeah, you can get lost really quickly looking at those shorter time frames and kind of forget what that higher time frame is doing.
Along with time frame comes the time that you're actually available to trade. Many traders have jobs. Many traders have responsibilities that they have to take care of. And you really want to choose the time that you're available to trade carefully and get to know what participation volume and the opportunities look like in that time period. If you're trading at night, learn to trade at night. If you're trading the regular trading hours, learn to trade the regular trading hours and be cautious outside those times.
Good advice.
Nice. Norman asks, any opinion on using the CFTC strategy?
The CFTC, like commitment of traders.
Well, maybe he can give us some more information on that. I wasn't familiar with the acronym.
I have not heard of that one before, so give a little clarity and we can maybe chime in.
Yeah, for sure. Well, this brings us to our third point of creating your trading strategy. This is something that we could make 30 videos about, which is creating risk management rules that you're actually going to follow, such as being smart about your risk-reward ratio and knowing when to get out. So do you guys have any thoughts on risk management or making rules for that?
Well, we have lots of thoughts on that.
Oh, I'm sure.
We don't have enough
days.
time this week.
Right?
Well, I'll start with this one. As far as risk reward is concerned, as far as I'm concerned, the most important thing the most important metric in trading is the risk to reward ratio. If you're not looking for trades that are worth more than you're risking to take the trade, you're putting yourself behind the 8 ball. We always call it keeping the math on your side. If you can be right half the time, but you're right for twice what you risk on each trade, you're making money, you're consistent, you're sustainable, and you're buying time to get better and better at what you're doing.
That's a great point. One thing I want to mention when it comes to these rules, there's thousands of different rules you can have within your trading plan. But I think something that we kind of forget about a little bit is what happens when I deviate from my rules. What's the rule in place that when I break a rule that I'm going to have to use to keep myself accountable? I look at it a lot of times, if we can treat traders like toddlers. Toddlers learn pretty well because there's a repercussion when they violate a rule that they have. Mom, dad, someone steps in and says, hey, it's a 10-minute timeout. The next time they go to break that rule again, it instantly starts to fall into play. Last time I did this, I got 10 minutes. I wonder what happens this time. And maybe it gets a little bit worse each
You
time.
can even say, hey, Santa saw that.
Right? It works. It works.
Yeah, we need some sort of like Santa Claus figure for traders.
Exactly. I think it's
something in some government department, something that comes around. And
I think it's as simple as a spouse. You check in with your spouse at the end of the day and they go, how did you do today? Well, I was up, but then I lost it. And if they're not prone to this concept of that idea of what goes through a trader's head, they're going to look at you. Why the heck did you lose money that you just made? It's common sense. Why would you lose it if you had it? So it kind of humbles you a little bit. And that, to me, is one of the biggest things to add into your risk management rules.
And there are some rules that you can kind of put forth. And Mick, I want to kind of throw this one to you.
Okay.
How many times do we see a trader whose average winning day is maybe $400, $500, $600, and then they put together a $2,000 losing day? Does that make sense?
No, sadly, it doesn't make any sense, but it happens.
It does happen.
you know,
It happens to professionals even.
You know, I think John would agree with me that you should never really be losing more money than your average winning day. It's all about keeping the math on your sides. There's nothing more painful than wiping out several good days of winning with one poor day of losing. Guilty of it. I've made that mistake.
Oh, I've
in the
never
past.
never done that myself.
No, not at all.
But yeah, that's really painful when you make one bad decision, potentially an emotional decision, and you give back 2 weeks of work. I've done it before, and it still stings.
Yeah.
From 10 years ago.
Yes.
You don't forget those.
Yeah. Oh, that's when you need Santa to come and say, don't do that again. I saw
Exactly.
that.
Maybe
Exactly.
having it one time and it's stinging and not forgetting it is what gets you over the hurdle to not make that mistake again. Like most mistakes in this industry,
Sure.
they should hurt, they should sting. You got to get over them before you can move forward. Though.
Take your lumps. I think that also ties nicely into point 4, which is to track your emotions. We'll say preferably in a journal of some kind. Keep track of how you're feeling when you make these trades too, because when you lose all that money, a lot of times it's not because of something that you looked at objectively. It's because you're just out there on a hope, out there on the limb, just thinking
Or
this is coming
just
back.
flat out angry.
Yeah,
Yep.
or bad.
Yeah. So a lot of folks think, or a lot of people suggest that you're able to control your emotions. They give you tools to try and control your emotions, and I've always found it to be thoroughly exhausting to do that. So I've kind of felt as though it's easier, maybe not easy, but easier than controlling your emotions, to learn to use your emotions to your benefit. And to do that, if you're keeping track of your emotions, the way you're feeling mentally, even physically and emotionally throughout these trades, and you can review those at the end of the day, actually feel your way through them. You're going to take a look and you're going to say, I remember that trade and it was a good trade. Here's why I took it. What was I thinking and feeling through that trade? Just reliving that trade twice a day, I think, can point out trends or patterns in your behavior and how you react emotionally to these situations. And it also can help you kind of define that difference between, okay, this is an impulse or an anger trade, and I've got to be careful of that. And it can also help you decide, what, this is a real intuition. This is something that I've got to pay attention to. The more you pay attention and learn to use those emotions in your favor, I think the closer you'll be able to find and recognize the real intuitions versus the impulses.
I'd like to share one tip as far as how you could better control your emotions, and I think you guys would agree with this. Anytime you put a trade on, know where you're getting out if you're wrong. Know where you need to get out, where you can accept, hey, I was wrong, the market's going to go here. If it goes to here, it's probably going to go further against me. Know where you're getting out if you're wrong, and also have a good idea of where you're getting out if you're right too. You want to get paid when the market goes to where you thought it could go to, and if you can take a loss where you say, I need to accept defeat here, you move on to the next one, and you're not hoping, you're not getting worried. It's over with, and you move on. You already predicted it as one possible outcome, so,
And don't move your stop.
Yeah.
Accept losses quickly.
Thank you for the asterisks on that.
Absolutely. And I think just to tie in with Mick there, we're talking about having a trading plan in general. Every single trade you're executing, make sure you have a plan within that trade. It really top-down approach. We've said it before. You have a plan for your month, maybe your week, and then your day, and then each and every trade. Continue to just bring things, hone them in, get tighter and tighter with that. It helps manage that risk.
Yeah, and Mick, your tip sounds suspiciously a lot like the 5th point on this list, which is to set process goals, not just P&L goals. And I think that is just crucially important. Like you said, don't move your stops. Follow a process that you can, think about your emotions, follow a process. Things will happen. P&L is not always the best indicator of what happens, even though at the end of the day, it's kind of how we define ourselves.
Right, but we're traders. At the end of the day, we have to recognize this is not a standard 9-to-5 job that every Friday or 1st and 15th of every month I'm getting a paycheck. We have to accept the fact that each and every time we sit down at the computer to look at the markets, chances are we're going to be 50-50 over time, making money and losing money. It's a matter of how do we create these rules, set these goals to help us make that profitable over time, and recognizing that one trade, it resonates with me. I've heard it from many people, but one time I heard this years ago, it's all about never let one trade make you as a trader. So you cannot define your career on one trade, but you also can't let one trade break you. Don't ever let one trade say, well, there goes my funded account because of that one trade. If you're going to lose a funded account, let it be, because you know what? I continue to execute on a plan, and you know what? That plan just wasn't coming together for me right now. So that's how I look at this. Make sure those are part of those goals that you're setting for yourself.
And I like the process goal. It's having a plan, putting together a hypothesis, recognizing the hypothesis is likely to come true, trading to that hypothesis until proving wrong. It's I want to make $500 a day, or I want to make $1,000 a day. I want to make $5,000 a week. I want to make $20,000 a month. It's those types of financial goals, or even time-bound goals, that push you out of your strategy. If you're not reaching your $500 a day goal, maybe it's not because you're not executing your plan. Maybe the market isn't big enough to get you to that level. I can't tell you how many times I've been in the pit and I have a 40-tick profit target goal for each day. I've been up to 38 or 39 ticks. My clerk says, hey, I think you're close enough. I say, nah, let me get this last couple of ticks. I take a loss, and that sends me into a spiral, and I end up losing on the day. I haven't done that in quite some time, but at the beginning, and when you start to be able to make that kind of money, and you set that goal and you demand that goal, it's going to take you out of your strategy, out of your process at some point. Keep your goals process oriented.
Well, someone who did hit their $500 goal in the day was Norman. Congratulations, man. Saw that there.
Nice,
Well
Norman.
done. And we'll take a look at the other thing. I'm on the fly right now. I'll look into that, get back to you.
I want to go out on a limb here.
Please
Talking
do.
about trying to make $1,000 a day, $5,000 a week, something like that. When you're trading your P&L, you are going to fail. You might catch it one or two times, something like that. But over time, you will definitely fail in this industry if you're trading your P&L and not trading the market.
It's because I think when you focus on that P&L and you demand that P&L, you start to attach your self-worth, your abilities, your skills to that P&L. And like I said, sometimes the market just is not big enough to provide that for you.
And it's an unrealistic expectation to think that you're always going to get what you want, and that's obviously more money in the trades.
Yeah, you can't force things that aren't there.
One last thing I just wanted to chime in real quick. We talk a lot about kind of what happens when things go bad. I really want to stress, when you follow your plan, whether you made money or lost money, it doesn't really matter. Reward those good behaviors, because it goes the same way. If I'm going to have a repercussion or punish myself for doing something bad, I got to remind myself, when I do things good, when I perform to the best of my abilities, no matter what that P&L is, make sure you're rewarding yourself on that side too. It's going to continue to instill those things within inside us, because a lot of this stuff becomes second nature, or it's subconscious when we're pulling ourselves out of a trade or we're executing that trade. So make sure you're instilling those positive aspects of
Create
your
a
trading.
neuro channel. Reward those good behaviors with
Right.
the endorphin rush, and you're going to solidify those. Maybe we'll go into some brain
It's a
chemistry
great point.
sometime. Yeah,
Right.
Great point, Dan. Well, just to do a little recap here for it. So our 5 things to do to start your trading plan this year: define the basics, establish your time frame, risk management, always important, track your emotions, and set process goals, not just P&L goals.
Jack, that was
five
nine.
basic things.
That was 9 things?
No,
Oh
I'm
my
kidding.
God, I forgot to count over the break. I seriously was worried we were off for 2 weeks. I was worried that I forgot how to do my job. Is that something I worry about? So, Dan, do you have a quote for us?
I do. I think this one, some of you, pretty much everyone's probably heard this one, but it ties in really nicely. From Benjamin Franklin: if you fail to plan, you plan to fail. Simple as that.
That's really good. I thought you were going to say like 7 years ago or something like
No,
that.
that was
Abraham Lincoln.
Abraham Lincoln. Thank you. 16th
Yes.
president.
Yes.
Illinois resident.
He was. Well, guys, thanks so much for tuning in this week. We're back on the weekly schedule, so we'll be back next week. We'll post that blog so you can see the written version of that. And in the meantime, go out there, mind your risk management, and Hogue,
Trade well.
see you later, guys.